Hold onto your hats. Michael Burry, the big short, has just tweeted, "You have no idea how short I am," yesterday. Okay, so a lot to digest here, guys. We're going to take a look at the charts, going to revisit the S&P 500, take a look at the US dollar index, and also have a look at the VIX and present an opportunity and a way where you can protect your investment portfolio using the VIX over the longer term as well. Plenty to go through. Let's dive in. I've shown this chart of the S&P 500 a number of times previously. So this is essentially the waves, the bullish and bearish waves the market has been moving in. It's been moving in 40 bar waves, roughly 58 days to 60 days in length. We're getting this kind of bearish momentum followed by a bullish momentum where you get profit taking from the bears. And then obviously some buyers stepping into the market, so some short covering. And then obviously you get the bearish momentum coming in afterwards as well. So we're kind of getting this period now where we're pushing towards the end of the 40 bar, or towards the middle, towards the end. So we've done around 26 bars. To be completely honest as well, if we take a look at this initial move higher over here as well, that would have been probably around a similar length as well. So that's around 24 bars really, before it started moving down. But we'll stick with the 40 bar trend. So, we could be coming into the end of this bullish momentum to the upside on the S&P 500. We're moving into the negative trend line resistance highlighted earlier in the week. We've had this kind of corrective structure higher as well. So, the jury's now out as to whether we're going to be starting to see some downside pressure coming into the market. And, judging by Michael Burry's tweet, he's obviously expecting some selling pressure coming into the market. Now, what I also want to go through today on the SPX, S&P 500, is also looking at the shape and the structure of these moves coming through here. So these corrective structures coming through here. They're all extremely similar in terms of how they move. When you're using Elliott wave theory, if I just come down here, Elliott wave theory is either a 3-wave rally, which is corrective, okay, or it's a bullish 5-wave rally, which is 1, 2, 3, 4, 5. Okay, so if we have a 3-wave rally like this, generally you have a 5-wave decline coming into it, a 3-wave rally, and then a 5-wave decline coming the other side as well. Okay, so these are what we call connecting waves. These are ABC corrections. So what we can actually see at the moment on the S&P 500 is this move through here is actually in 3 waves still. So it's an A, B, C. Okay, similar to this one through here, an A, B, C, A, B, C. These are connecting waves, which means until we get a 5th wave rally, so a 5-wave rally, that indicates a bottom is still not in just yet in the stock market. Okay, think of the stock market seasonally as well. November and December are generally very good months for the stock market. Consumer sentiment and market sentiment is positive. People are spending money. However, I think seasonally at the moment, it's not your typical market in terms of what's happening in the conditions. So, we are in a bear market still, possibly heading towards a recession. So we still need to keep that in mind. So maybe, just maybe, seasonality data may not actually play a big part in the market. I would love nothing more than the stock market to continue towards record highs, but we have to play and trade what we see. So we can't get too caught up and too emotional about a bull market or a bear market. All we have to do is try and interpret the actual technical structures. And at the moment, this structure is indicating a corrective rally rather than a 5-wave bullish rally. Okay, so if we get a low taken out around 370 on the SPY, if that low is taken out, we're going to be heading a lot lower in the stock market. So how would you potentially trade this? Okay, I'm just going to clear the chart. So we obviously have this negative trendline resistance coming into play around here. So there's going to be a reaction of some sort just around here. All right. We also have previous resistance, previous support coming into play. So a touch through here, touch through here, touch through here. So we already know that the 400, 410 level, there's going to be some resistance coming into play down through here. What I also want to highlight is if we take a look at the move from the high on the 16th of August to the low on Friday the 14th of October. That appears to be a 5-wave decline. So I've highlighted this previously as a precaution, a wave 1, 2, 3, 4, 5 waves down. A, B, C, wave up. Generally, what did I say previously when you get that 5-wave rally? So you'll have a 1, 2, 3, 4, 5, A, B, C corrective rally, then a 1, 2, 3, 4, 5. So, just using Elliott wave theory alone, that would possibly suggest that we could be heading lower from this target zone over the coming weeks and months to a much deeper correction. Now, how far will it go down if it is a bearish market? So we can use our fib extension tool, so we can bring it down from the start of the impulse to the bottom, bring it up. Let's say the move finished around here. We may see a move into the 161, the 1.27, or the 1-to-1 parity. So that would actually take the S&P 500 or the SPY down into the high 200s, low 300s area over the coming months. Okay, something to keep an eye on. How are we going to play this? I guess we really need to see on the shorter term time frame. We will need to see an initial move lower, similar to what happened over here from this move down. So you had an initial 5-wave decline, 1, 2, 3, 4, 5, A, B, C correction, and then you can probably short the low in here with the stop loss above the B wave. Okay, if we get that same sort of thing happening through here, we should have a, wherever it comes down from, 1, 2, 3, 4, 5 initial decline, A, B, C. You can then short the B wave low or the wave 1 low, and the stop loss would be the C wave high through here, ready to start rolling down more aggressively. Okay, that's the shorting strategy. Now, on the other side of the coin, if we get a complete breakout from the negative trend line, so if the stock market actually breaks this negative trend line, and we also get a 5-wave rally, so the stock market goes 1, 2, 3, 4, 5. The pullback in the market will be an ABC, okay? And then we can start to look for the long trades through here into Christmas. So, we're not saying we're going bullish or bearish just yet. We need some time to let the price action unfold, but we are going to know very soon, I'd say probably in the next week or 2 weeks, whether this is a bear market rally, a corrective rally, or whether this is going to be the start of a new bull market going into Christmas. Okay, so that's the S&P 500, the SPY, SPX in a bit more detail. Let's jump into the DXY. Okay, the dollar index. So, since our video last week, and even on Monday as well, we've had a major turn down on the dollar index as expected. So we were looking for the dollar index to turn sharply lower, coming through here at the top of the channel structure, I guess. So we've got this rising channel formation. Generally, when you get a tag, you get a rejection lower, or at least a reaction of some sort. So we don't know whether this is going to be a full-blown reversal or whether it's going to be a pullback for a period of time before the next move higher, similar to what happened back in April 2016. So we've still got a bull market in the dollar index, the S&P 500 or the SPX. If the bearish analysis is correct, then the dollar index, we can expect that to start creeping back up again as well, okay? So it's very unlikely that the S&P 500 and the DXY are both going to decline at the same time, okay? The dollar index is considered a safe haven currency, the global safe haven. When risk assets like the S&P 500 declines, money flows into the US dollar index, so the DXY, okay? So that's why since the start of 21, I guess, even through here, 2022, we've seen this sharp parabolic rally on the DXY as risk assets like cryptocurrencies and the stock market has continued to decline. Now, let's take a look at the short-term price action of the DXY. I've highlighted a support zone through here. We are expecting probably the dollar index to hold up some speed, some momentum around here. There's some support coming into play, a similar touch through here, coming through here as well. So I would expect the DXY to have a bounce of some sort. Okay, not expecting a full-blown bottom, but possibly a bounce to some degree. Now, if we go to the daily time frame and chuck in the 200-day moving average, we do have the 200-day moving average coming into play as well. Okay, so that is going to create a bounce, or generally it may create a bounce to some degree. So if you take a look back in time, there was a bounce when it was providing resistance. Through here, it broke clean through, okay, provided support through here, broke clean through back in 2018, provided support through here, and again through here as well. So, you know, resistance through here, support through here. So the 200-day moving average, more often than not, it does provide a level of support or resistance to work from, okay? So that would suggest that we may also see the DXY kind of slow down a bit when it does reach the 105 area of support. Now, if we go to the Elliott wave count that we were tracking on the DXY, so I'm just going to kind of draw this in. We've either had an A, B, C, or a B, C wave coming down. Okay. I mean, we could put the A wave over here or put the A wave over here. That could be a 3-wave decline in there as well. So either way, that could be a 5-wave rally, A, B, C, down for a wave B, and then a 5-wave decline coming through here. So if we take a look here, the DXY may still have one final push to make to the downside. That could be a 3, 4, 5, or we could put 4 over here and 5 coming down here as well. Okay, so yet to see whether DXY has completed this 5-wave decline, but it appears as though it's coming towards the end of its initial move to the downside. Now, if this was a full-on reversal in the market from the top of 114.77, so if this was the major market top, this would need to be a wave 1 down here. Okay, so that would actually be a wave 1, A, B, C for a wave 2, 1, 2, 3, 4, 5. That would be a wave 3, 4, 5 coming down here as well. So that could still be the case, but at the moment we're kind of leaning more towards a sideways, or I guess a corrective pullback. Okay, if Michael Burry is correct, okay, and the stock market turns aggressively to the downside, this wave 1 would be incorrect. This would need to be a wave A. Okay, let me put them in at the same time as well. A, B, C. Okay, that would need to be a corrective decline because the dollar index would turn sharply higher from this support level. Okay, it would start to move up again in 5 waves. So it really depends on the stock market, market sentiment. We need to give the price action some time to unfold, and then we can start looking to play. We have started taking measures on the USD JPY. We're going to be looking at the USD Swiss franc as well. They look attractive for long positions in the trading floor. But what I do want to touch on before I knock this webinar on the head is the VIX. Okay, so the volatility index. Now, you're probably aware the VIX is obviously heavily shorted and manipulated to some degree. Now, before the stock market turned sharply lower, we did actually put out an article on how to protect your investment portfolio using the VIX. Okay, so what I will be doing with the VIX trading around these levels here, you can look to buy call options, you know, way in the future, strike price around 24, 25, give yourself 6 months on the 6 months at least on the VIX. Okay, so you're looking for VIX call options, strike price around 24, probably look at March, April, May next year for the expiry date. And that's just going to give your investment portfolio some protection in case the stock market does decline. So whatever you put into the volatility index as a option, okay, as a call option, just, you know, that could be equity that you're happy to lose. Because if we do get a breakout to the upside, your VIX call option is really going to generate some profits and protection to your investment portfolio. If you own an investment portfolio and the VIX breaks down and expires worthless, that will indicate the stock market is going to recover and begin to move higher as well. Okay, so I do understand the VIX is heavily shorted, but when something major does happen in the stock market, the VIX tends to explode higher, okay, coming out of the negative trend line. So it is still worth having protection. using the VIX if you do own a cryptocurrency portfolio or a stock portfolio. Okay. Cool. Right. That's it for today, guys. So we've gone through the S&P 500, the bearish scenario, the DXY, the technical structures there as well, how to protect your investment portfolio with the VIX. If you have any questions on that, please reach out to the support inbox. If not, we'll catch up again in the next webinar. Cheers.